Performance of a new Wall Street line dancing. It doesn't matter what statistics, indices, or stock market gurus you trust when it comes to stock market direction, you just don't know. Investing time and study is wasted on projecting course corrections that never materialize. Even more, the effort is wasted by comparing portfolio market values to a variety of unrelated indices and averages. If we recognize that we can't predict the future or change the past, we can better handle ambiguity. Let's use data that we don't have to guess about and that is directly linked to our own personal investing strategies to make portfolio performance reviews easier. At some point in December, everyone begins to reflect on the year's achievements and plan for the new year. Every year, this cruel rite is carried out. My year-end objectives differ from yours. LOL, and rot the fat cats of Wall Street investors as well as advisors who use the correct alphabet decide on how to make the next year's financial performance better than the last. Wasn't there a time when long-term development towards specific goals was a priority? The use of issue breadth and 52-week high-low data for navigation and cyclical analysis peak-to-peak, etc., and economic realities as performance expectation barometers make a lot more sense to the individual investor. In a 12-month race, how did the idea of investment portfolios competing against one another come about? What could possibly be making the most powerful entities in the universe laugh? Each year, they can observe the numerous fee-generating transactions that result from your performance agitation ritual. Wall Street ensures that the vast majority of investors will be unsatisfied with something at any given moment by focusing on short-term results and creating an environment similar to the Super Bowl. As a result, I feel that a stock portfolio is more difficult to understand and manage than a collection of one-size-fits-all consumer goods. The only long-term goals you need to focus on are boosting productive working capital and expanding base income. It doesn't matter if the stock market, interest rate trends, or the yearly calendar influence either of these objectives. Investors are shielded from short-term, anxiety-inducing events or trends while permitting a more objective, non-competitive, and constructive form of performance review than was previously available. In a nutshell, working capital is the whole cost basis of the assets and cash in the portfolio, whereas base income is the dividends and interest received by the portfolio. Withdrawals, deposits, and capital gains and losses all have an impact on the growth of working capital, which in turn has an impact on the growth of base income. Investment-grade quality, just fundamentals, please, and or the ability to generate income are both indicators that investment is no longer productive. With strong sensory control, it is feasible to minimize these unpleasant interactions. Let's develop a everything you need to know chart to help you succeed at investing in a low-failure, emotion-free environment. Target achievement. In the graph below, your portfolio management objective is to keep 3 of the 4 data lines trending upward. Deposits and withdrawals must be tracked individually. Paying fees and commissions that are unrelated to any transactions should be counted as a working capital drain. It is critical for project selection and profit margin determination that your criteria are well defined. Line 1's working capital is expected to expand by 5 to 12 annually, depending on asset allocation. Compounding takes time, so if possible, wait until the second year before calculating an average. Deposits and realized capital gains all contribute to this upward-only line of dividends, interest, deposits, and recognized capital gains, while withdrawals and realized capital losses deduct. Take another look at some of the customary year-end procedures while you're at it. Using losses on high-quality companies to counteract capital gains becomes dubious because the deduction from working capital is always greater than the tax payment. Avoiding dividend-paying equities is as dumb as asking your boss for a pay cut in person. There are 2 simple realities at the heart of this: 1, you can never make too much money, and 2, a profit is always a gain. High-quality stocks should not be encouraged to take losses. In order to maintain their taxes as low as possible, let them know that you're doing your part. Line 2 indicates your base income, which will always rise as long as your asset allocation is well managed. In all cases, the only exception is if all of your base income comes from stock dividends, which is a more volatile form of investment income. You may view your prior trading results on the net realized capital gains line in the 3rd column. Keep track of this number as your portfolio expands because it is a direct reflection of your stock selection strategy and the rules you employ to take profits. It's unlikely that your criterion for investment selection or profit-taking discipline will deteriorate as you construct a portfolio if you keep to your cost basis and only invest in investment-grade securities. Gain is better than losing, and unless your criteria are really conservative, you can always find something to buy with the money you earn. With 3-8% singles, you'll score more runs, but which is easier to accomplish? The growth of line 3 should be increased in a rising market measured by issue breadth numbers. Asset allocation takes into account the cost basis of each investment class, resulting in an increase in base income. Unrealized gains and losses have no value, no matter how big or small they are. Net realized income from a well-informed decision should be higher than zero. Before moving on, there is one more item to remember. Investing is a risky business, and you can never be too careful. Put aside popular Wall Street metrics, tea leaves, and analyst predictions before making a judgment. The fundamentals such as profitability, the SP rating, and dividend payments should give you caution. Even though market value can't be relied upon to save a life, it can be valuable in other circumstances. As a result, we arrive at line 4, which depicts the changing total portfolio market value. Working capital is going to fluctuate a lot over the course of this line 1. Lines 1 through 3 on the chart are continuing trending higher after several market cycles, regardless of how line 4 is doing. You'll notice, though, that line 4's lows begin to appear above the previous highs. Despite the fact that market value cannot be controlled, it is a good sense. As line 4 capital gains continues to dip below line 1, net realized capital gains are expected to climb faster capital losses. It is more likely that you have allowed greed into your portfolio and that profit-taking opportunities have been overlooked when market value exceeds working capital in 100 income portfolios. Never let your guard down. Unrealized gains are recorded on Schedule D as realized losses, which include future revenue from income instruments. When your portfolio reaches a new high watermark, look for an SP-rated asset that has fallen out of favor and sell it. What distinguishes this method from others, and why is it not taking advantage of more recent advances in technology? Nothing about an index, average, or other comparison is mentioned, and that's fine. In order to steer clear of Wall Street's costly trades, foolish speculations, and inevitable disappointment, adopt this way of thinking. Portfolio market value has a practical use, but it's not the kind Wall Street wants to see. A personal benefit of its presence in this approach is that it serves as both a clarification of expectations and a signal for the portfolio manager to take action on their own. Line 4 is where most investors put their attention out of habit because Wall Street has persuaded them that a lower market value is always bad and a higher one is always good. If you want to attain your goals, you need to think outside the market value versus anything box. For cycles, they don't necessarily match perfectly into the calendar year. Your new line dance will be greatly influenced by the track you choose. The market value line is a powerful analytical tool that you may use to your advantage. Profit margins might be lost due to an excess of working capital. If it falls below its current level, look for purchasing opportunities. You've either had a decline in the quality of your holdings or your asset allocation has been revised for some possibly wrong reason if your base income has decreased. Your market value can drop if the stock market is bad or interest rates are rising. Finding out what went wrong is the most crucial thing to do. You're not sure what's in your portfolio if you get a surprise. It will also be important to develop a more accurate method of assessing the market. On CNBC, you'll hear a lot of people talking about popular averages and talking heads. Monitor market stats, such as the change in the overall market, to get a better sense of what is happening. This is better medicine than the ones you had access to your entire life, or medicine than the